Welcome to the panel on the new politics of central banking. Some of you may wonder why we put the notion new there, but new economic thinking, new politics, whatever. As is my custom, I'll start with a lyric that foreshadows what we're doing. It comes from Leonard Cohen. It's the cynical national anthem. It's called Everybody Knows. Everybody knows the dice are loaded. Everybody rolls with their fingers crossed. Everybody knows the war is over, but everybody knows the good guys lost. Everybody knows the fight was fixed, the poor stay poor, and the rich get rich. That's how it goes. Everybody knows. In the post-2008 crisis environment, we've seen on both left and right in the United States, and then increasingly in other places of the world, a great deal of cynicism and despondency pertaining to the whole financial system. But at the core of that, at the hub, is the central bank. Many central bankers enjoy what you might call an exalted status, and at the same time, privately, they complain that they're asked to do too much. I once had a meeting with an official in Italy, and he was a good-spirited guy, so I decided to tease him at the breakfast a little bit. And I said to him, "How does it feel to get up every day and try to control something you can't control?" And he looked at me and he grinned and he said, "Robert, the only thing that gives me solace is that I know if I admitted it, I would make it worse." When I was in Korea recently, I gave a talk to the World Knowledge Forum, and I asked the people in the audience, and I'll ask you, if a clairvoyant is at 100 on the scale and I'm at 0, are Mario Draghi and Janet Yellen at 13 or at 93? We treat central bankers like they're all-knowing, and yet central bankers, as what you might call cagily honest as Mervyn King was, produce things called fan diagrams that show that after a couple of quarters, there's really no basis for a great deal of confidence in econometric estimates. I guess, in the context of INET, one of the things that we talk about quite frequently is the notion of radical or ontological uncertainty. The idea that you don't know and can't know. I recently saw a film about the Eurozone where toward the end of the film, an Italian economist got up and he said, "This is very confusing to me. We used to sit on the side of markets and we used to berate the central planning committees of the Soviet Union and of the communist countries. And now we all defer to the central bank like they can fix everything. Isn't that strange?" I think what Hayek called the pretense of knowledge surrounds these questions. And when we have an event that is so traumatic as 2008, there is an unmasking that takes place. And there are questions about, there was a lot of hostility about bailouts. My own feeling was the problem wasn't that they did the bailout, the problem was in the years before that led to having to do the bailout. There are obviously questions of political economy. In the United States, where in the post-Citizens United environment, we have a turbocharged money politics system. The question is, can the central bank even do preventive medicine? Do they have the political power? Do they have the regulatory and enforcement power? Does the chairman have a stable position if they try to discipline the financial sector? This problem is not just one of politics. Around the world, we've seen, and the person to my far left, Andrew Sheng, is the one who first showed me the data on this, we've seen a tremendous amount of financial deepening. The way I would call it in a nautical metaphor is that we have oceans of capital sloshing around, and we don't have a navigation system. It's like somebody turned the lights out on the lighthouses. Well, the central banks, in the absence of knowing what the future looks like, become that guidance system. They try to shape our expectations and channel capital flows and make things work in a coherent manner. But when the politics of central banking, when the unhappiness leads to people protesting at the Jackson Hole Conference, when people are despondent about central banks, when people like Rand Paul are running for president in the United States and wants to reform or do away with the Federal Reserve, the question becomes, can a central banker say what he means? Can he mean what he says? Can they implement things when they are in the crossfire of politics, like central banks all over the world are today? We have a crisis of legitimacy. We have very, very new and novel instruments. And we have, obviously, the problems of melding together different central banking systems in different countries to put together a world system. I have three extraordinary experts alongside me to make you feel better than I have about what the possibilities are, perhaps. We'll begin with Perry Merling, then Andrew Sheng, and Lord Adair Turner will finish. Perry?
Thank you. I start with here. I thought I would, why is central banking difficult is my starting point. And I'm not talking about the where Rob started. It's difficult because there's an unknowable future, and so it's difficult for the central bankers to do their job, okay? I'm thinking about why is it difficult for us to understand? Why is it difficult for the general public to understand? Why is the communication problem so difficult? And there are four features that I'm going to emphasize today. One is the hybrid character of the central bank, the essential hybridity. One, the hierarchical character of the monetary system. One, and third, the inherent instability and how financial globalization has made all three of these things more difficult, and the way in which standard economics basically abstracts from all four of these things. And so these are essential features of the monetary system. These are essential features of the world in which central bankers are operating, and yet economics is not much help to them in understanding those worlds. I'm going to come at the end, if I have time, to some remarks about central banking and democracy, or central banking versus democracy, but I got to move fast if I'm going to get there. So let me just, by essential hybridity, I'm not going to be able to go through all of these things, so let me just say, hit the high points. The point is that we can think of the central bank as the government bank, and in wartime it is, making sure that the government can issue the debt that it needs in order to fight the wars and save its sovereignty, and supporting the government debt after the war too, the stock of debt. But in peacetime, the central bank becomes much more of a banker's bank. In all times, the central bank is both. It's a hybrid entity, both banker's bank and government bank, and the boundary between those things shifts, depends on what's happening in the world at the time. This puts the central bank in a tricky position, a contradictory position. It has sort of two clients, and the changing over time, it creates lots of opportunities for conflict of interest and so forth. So this is one reason that central banking is difficult to understand, because we tend to think of it either as a banker's bank or a government bank, but in fact, it's both. Okay. Another reason that it's difficult for us to talk about central banking is the hierarchical character, the inherent hierarchical character of monetary systems. I'm showing on the left of that slide that the central bank currency is at the top of the hierarchy, domestic hierarchy, bank deposits below it, domestic credit below that. But there is something above the central bank, world reserve currency. In the United States, we find this particularly difficult because, of course, the world reserve currency is also the dollar. So the conversation about central banking is especially difficult in the United States. On the right hand, I'm showing the way that hierarchy seems to be organized today after the crisis as between countries. The dollar on the top, the C6 swap line between the top 6 central banks is sort of the next layer of the hierarchy, and other countries are tied into this international system lower down, bilateral swap lines, regional pooling situations, the IMF as the friend of people who don't have any of these other better connections to the world, national money, national credit. It's an inherently hierarchical system, and we have a hard time thinking about hierarchy, I think. Inherent instability of credit. Credit anticipates an uncertain future, so mistakes are inevitable, and it gives lots of room for externalities and hurting. Money doesn't manage itself, as Bagehot said a long time ago. This essential feature of the credit system, that it's inherently unstable, is something that was emphasized by Ralph Hawtrey a century ago. He was talking largely about a world of trade credit. I think it was also emphasized by Keynes. He was talking about investment spending. The finance side of that was emphasized more by Minsky, the business credit. The system we have now and the crisis that we've just been through is a newer version of this inherent instability of credit. Market-based credit, shadow banking, some people call it. I like to call it market-based credit, and I say, what is this? This is money market funding of capital market lending. It's a shift of the credit system into capital markets. As opposed to Minsky, this was really about household mortgage credit, not business credit. It was about capital market securitization, not bank lending. And it was a global system. It was about global money market funding, not domestic deposits. And yet, the inherent instability of credit was nonetheless a feature of that new system, as we have seen. So the fourth idea, financial globalization. So this is a quote from a famous article by Kindleberger. It's actually Dupre, Kindleberger, and Salant. I don't know why I put Kindleberger. Dupre was the first author there. Financial globalization has made all of these ideas more difficult for us. This is a quote from 1966 in which he's seeing the future. And I'll just read them. An effective, smoothly functioning international capital market, says Charlie, is itself an instrument of world economic growth. So he's saying we need capital markets for economic growth, not a nuisance which can be disposed of and the functioning of which can be transferred to new or extended intergovernmental institutions. He's talking here about the IMF. He's talking here about the SDR. Okay. But he continues on. The main requirement of international monetary reform is to preserve and improve the efficiency of private capital market while building protection against its performing in a destabilizing fashion. This is the inherent instability of credit. Okay, so the system is now global. Okay, the instability is now global. Okay, this adds a layer of intellectual challenge to the problem of understanding the role of central banking. And economics is not much help. That the post-war period, the emphasis of economics turning itself into a technocratic discipline with scientific answers for politicians. We know how to stabilize business cycles. It's a hydraulic system. We turn this handle, we turn that handle. Little loss of confidence in the 70s, a return of confidence with the great moderation, inflation targeting idea. The way that economic debate inside the profession has been organized around Keynesians versus monetarists, who largely agree, in fact, on a monetary Walrasian view of the world. They argue a little bit about whether fiscal is better than monetary or whether active management, laissez-faire. Now there seems to be no disagreement. There's just new synthesis and great moderation in which we have rules, but they're monetary rules, not fiscal rules. This was not much help, but this was the state of the art when the world changed. And by that I mean the financial crisis. So here's the balance sheet of the Fed, and the two vertical lines are the Bear Stearns crisis and the Lehman Brothers and AIG crisis. But you can see the ballooning of the balance sheet. On the top is assets, on the bottom is liabilities, which I'm booking as negative numbers. I call this slide a Bagehot moment because this is the moment when the central bank stepped up as lender of last resort. Okay, this is what it was doing in between those two lines, and it wasn't enough. And they had to do something more. Okay, and what they did was essentially war finance. They did. They supported the private market directly by buying securities, doing money market funding of capital market lending. If you look at the balance sheet of the Fed, that aqua triangle there is $1 trillion worth of mortgage-backed securities. That's capital market lending. Okay, and the liability side, these are excess reserves. That's money market funding. So shadow banking is on the balance sheet of the central bank. That's what the central bank did. The central bank put a floor on the collapse of the global shadow banking system by moving the marginal part of that system onto its own balance sheet. And of course, it was first the Fed, and then other central banks have followed suit. This is my second Alice through the looking glass kind of slide. I call it a Bretton Woods moment. This is showing the interest rate differential between Eurodollar lending, okay, and the Fed funds market at 1 month and 3 months. You would think those things should be the same, right? The difference between those interest rates should be the same. These are dollars. One happens to be commercial dollars in Europe. One happens to be the domestic currency in the United States, but these are dollars, and the dollar trades at par. The interest rates moved in this crisis, before the crisis even, to 100 basis points differential. And then between Bear Stearns and Lehman was maintained, you can see stabilized there for a while, and then when they lost control again, moved to 300 basis points, okay? This is pressure on the international system, okay? There was a pressure to shift away from the par relations between the international world reserve dollar, okay, and the domestic dollar, and the only way they were kept at par was by creating these very large interest differentials, and we survived that crisis. You can see it's now back at zero. So it was a global financial crisis. And it was a global financial crisis because the global funding markets are dollar funding markets. And so when there was a freeze up in dollar funding, it was a global crisis. So it's a Bretton Woods moment as well as a Bagehot moment in which we're rethinking the way the international monetary system is operating. Here's just a little analytical structure that I've used in previous papers to think about shadow banking as capital market, money market funding of capital market lending. You see I'm calling the capital funding bank, okay, instead of the shadow bank there. Residential mortgage-backed securities are the capital market lending part and money market funding. But I'm putting this diagram up here for a reason to emphasize the key role here in market-based credit of dealers who are making markets in money, that's the global money dealer, okay, and dealers who are making markets in risk, those are the derivative dealers that I'm putting below there. The dealers who are standing in between the asset managers on the one side and the shadow banks sort of on the other side. So the key role of dealers, okay, this is a particular feature of the market-based credit system that was not characteristic of the bank lending system. That means new central banking role, okay, and a new central banking role in backstopping those dealers, okay. That's what the central bank did, okay. That's what that balance sheet is showing you. What the Fed did was to backstop the global money dealers, backstop the derivative dealers, and put that when they were unable to make markets. The central bank did. It acted as dealer of last resort in the crisis. That's what it actually did. Whether that is a good thing or a bad thing, whether it made mistakes, this is what we're now dealing with as a fact of the world, that the central bank expanded on Bagehot and was not just a lender, but a dealer, not just in money markets, but also in security markets. That's a new thing. And the regulation that is developing, well, no, I'm skipping ahead too fast. Okay, so this creates some new politics. The dealer of last resort by itself is a big shift. I mentioned before that this is using the technique of war finance, the backstop of the government lending in order to beat the foe, the threat to our sovereignty. It's using that strong weapon that the central bank has to backstop private finance. Okay, this raises issues of, are they acting in the public interest or are they acting in the money interest? You know, whose agent are they? Okay, this is some of the things that Rob was mentioning at the beginning. Then they've continued. I want to make a distinction in this slide between the dealer of last resort putting a floor under the crisis and what they've been doing since then with monetary stimulus, which is a different thing. deliberately distorting private asset prices, deliberately expanding the public balance sheet in order to try to stimulate the economy. This has its own political consequences. Let's see, what would exit mean? I think maybe I should skip over that in the interest of time. Emerging market structure. So this point here, what is the reconstruction of the financial system that seems to be happening is the creation of these large central clearing counterparties, which are essentially matched book dealers, meaning that they have the same exposure on their asset side as on their liability side, which means that the main risk they're exposed to is liquidity risk, not capital risk, and that means that the central banks are inevitably going to be backstops of these operations, okay, because that's where the liquidity backstop always is. The job of the regulators and policy reformers at the moment is to try to create a robust private first resort system so that we don't always jump to the central bank right away. But the central banks are going to be backstopping these central clearing counterparties. And as a matter of fact, de facto, and we are going to have to, there's politics associated with that. We're going to have to get work on that. On the other hand, that separation of the market-making structure into a matched book part and a speculative book part means that hedge funds and speculators, who are actually the market makers, they're absorbing imbalances in supply and demand on their own balance sheet. Their main requirement is a capital backstop. That's local. The fraught politics of stabilization is that liquidity is inherently global. Solvency issues are inherently local. Liquidity crises move prices, cause insolvency. And so there's always going to be an argument about if this is a liquidity crisis, therefore it's a global problem. No, it's a solvency problem, therefore it's a local problem. This is the politics, new politics of central banking. And I will skip that one too, so that I can say a word about democracy. I begin sort of where Charlie Kindleberger was trying to say. Proposition 1, that notwithstanding all of its imperfections and faults, the market economy, a market system, survives politically because it serves as an essential infrastructure for democratic political forms. So there's a relationship between a market economy and democracy. A positive one, I'm saying here at the moment. They're supportive of one another. Proposition 2 then brings in the monetary system, that the monetary system serves as the essential infrastructure for the market economy. Okay, so this system that the central bank is sitting on the top of is the infrastructure, okay, of the market economy, and in that sense also a sort of infrastructure of democratic political forms. Okay, these are, I'm sure, controversial things. Okay, but I'm stating that first positively. Okay, democracy and finance. Now here's the democracy versus finance part, okay? That, as I said, the central bank is a hybrid institution. So there's inherent contradictions between the public interest and private profit, between local considerations and global considerations. These are contradictions that can't be resolved, so they have to be managed, okay? That's the point, management. There's a lot of talk about central bank independence. And I think most of this talk is not understanding the nature of central banking, that the notion that a central bank could be independent from political pressure, but it's a government bank. What are you talking about? You know, dependent from regulatory capture, but it's a banker's bank. You know, these in its essential character. So here again, I think management of this is the issue, and the guiding principle might be that we should try to make sure that the central bank provides liquidity and doesn't do capital bailouts. Okay, it's not about solvency; it's about liquidity, and that it charges for that. Okay, in some way that we need to figure out. All of these things are difficult enough in standard banking. The challenge of market-based credit makes them harder, because making markets means making prices. What the central bank is doing is essentially creating the outside spread in these prices, and private profit-making dealers are making the inside spread. So central banks are moving prices around by sort of implicitly providing at what price are they going to backstop the system. This is political. You know, and that's the way it is. The contradictions and dynamics of hybridity are on display and are going to be much more on display in a market-based credit system, which seems to be our future. So this is a summary. Why is central banking difficult? It's difficult because the language we have to talk about central bank is a technocratic language that obscures the political reality, okay? This is true in theory, our theoretical structures, monetary evaluationism, as I call it, which continues to be true in the DSGE models that have basically abandoned having money in them at all. And the idea that somehow the fact that we're doing all of this with science and computers or something, that this is a sort of mystification of the politics makes it look like science. But the politics are shot straight through. This is the point. What is missing from our understanding of central banks, and therefore our conversation, and therefore our public dialogue, okay, is the essential hybridity, okay, the inherent hierarchy, the inherent instability of the world in which they live, and the key fact that all central banks are dealing with today, which is financial globalization, that they are one central bank and there's no world central bank, that it's that the world, the financial system is larger than they are, so we need some new economic thinking. So here's my favorite quote from Minsky from 1967. Capitalism is essentially a financial system, which I have taken, maybe this isn't exactly what he meant, to say we need to think of banking as a payment system. We need to think of banking as a market-making system. These are two features of money that are nowhere in standard economic theory. They are everywhere, by the way, though, I'll make a little advertisement, in the course that I'm teaching on Coursera starting May 3rd. Okay, that's the final further reading there, which is free and available to everyone. Thank you.
Next up is Andrew Shing, who recently produced a report for the Fund Global Institute on shadow banking in China. Andrew?
Thank you, Rob, for inviting me to this wonderful conference. You know, when I sat down and started thinking about this, I saw the word liberté, égalité, fragilité. I thought there was one word missing, which is tragedy. And if you add them all up, it's L-E-F-T, which is left. Now, I want to be, thank you all for inviting me to in Paris, where the socialist president, Mitterrand, said defined what was supposed to be the essence of politics. It's about signaling left and turning right. And the politics of central banking should be signaling right and turning left. So that's essentially what I'm, trying to, say here. Now, what are my key points? I don't want to be seen dumping on central banks, but central banks entered into unconventional policies because the political economy of fiscal policy was unable to act decisively and toughly to deal with the financial crisis. That's the essence of it, right? They were thrown into this. I totally understand this. But as the Bank of Japan, who had the most experience in dealing with unconventional monetary policy, said it's easier to get in than to get out. But now we're entering into an escalation game. The balance sheets of the central banks are getting bigger and bigger. Global credit is rising higher and higher, and at lower interest rates, all of which national central banks, as Perry says, can't control it because it's moved global. So if banking is global in life and national in death, and central banks have to bail it all out, what's the answer, right? So is QE costless? And obviously, I think QE is only reinforcing the long-term stagnation and slower growth. Maybe it's not a bad thing for global ecology, because from the ecological point of view, global consumption at its present rate is unsustainable. Maybe that's what is causing the overall slowdown. We couldn't go at this speed. But what the problem is, inequality that is existing in the world today, is that reserve currencies can engage in QE, but the cost of it will be borne by emerging markets, which will have to take a lot of it. And that's the global politics that we're thinking. Now, how should we take new economic thinking into this? Well, the major insight is that the last crisis was not a national crisis, it was a global crisis. It was a systemic crisis. And that the sum of the whole does not behave like its parts due to the reflexive action, the interaction between the parts. We don't understand how that reflexive action is going. And what are central banks doing? As we know, if the theory was wrong, the cognitive function, in George's words, was wrong, but the manipulative function is still operating on the past cognition. And so that manipulation has become escalating in size, and the old medicine is not working for this new disease, and we don't have a new compass. Now, as Claudio Barrio and others have shown, the crisis occurred because of regulation, tax, information arbitrage. Credit basically moved off balance sheet, offshore. The Fed has $9 trillion worth of US dollar credit, which it can't control. And it's growing. The same with euro credit, yen credit, in future renminbi credit. So all this is creating huge inequality in the system. And I want to explain why. Because there is now concentration in every field. One of the first mindsets of the global thinking, the economic mainstream thinking, was that things behave according to a normal curve. And we know that it behaves according to power laws. And power laws is about concentration. And central banks themselves have become part of that concentration, and that's what we need to think about. Now, let's look at how the balance sheets have grown. They went from, this is Financial Stability Board data, which you can find, and the IMF. They went from 3% of global financial assets to 8% of financial assets, excluding derivatives, right? It's 22 trillion, right? Out of 282 trillion, or about 30% of world GDP. Now, advanced central bank, country central bank balance sheets are smaller. Swiss National Bank's 80% of GDP, but they've now risen to, 25, somewhere to 25 to 40% of GDP. Emerging market central bank balance sheets are smaller, larger relative to GDP, but that's because, they do a lot of FX intervention. But essentially, post-crisis, central bank balance sheets are somewhere between 3 to 4 times larger than before. And the bad news is this. 5 of the top central banks in the world, which is Fed, ECB, Bank of England, BOJ, and People's Bank, accounts for $15 trillion worth of assets out of 22 trillion worth of central bank assets, which is 68%. They are the most concentrated, right? And their action affects everybody, which is why we're now concerned about the politics of central banking. Now, in the balancing the benefits and costs of enlarged central bank balance sheet, this is the Jaime Corona sort of basic analysis. You have operation at the FX intervention. You're supposed to stabilize the market, but the problem, as the People's Bank know, sterilization costs can be very large. The domestic banking system pays a certain price because you freeze a large part of that liquidity in the central banks through reserve requirements. Lender of last resort functions is very good for crisis management, but it creates huge moral hazard. There's a central bank put, and there's higher market concentration because of that. Now, if you want to revive aggregate demand at zero bound, the theory is that lower interest rates, the QE, would revive aggregate demand, and we've known that it's not necessarily the case. And then, aiding fiscal funding, lower interest rates enable larger fiscal deficits, but that's become a drug in which the Ministry of Finance says, any problem, you central bankers take care of it. So, I read very carefully Ben Bernanke's latest statement that central banks are not responsible for long-term real interest rates, but I think he's forgotten the reflexibility between the national balance sheets and the global balance sheets. Because if central banks cannot affect the long-term interest rate, why are we increasing the balance sheet 4 times pre-crisis level? Why are they doing this? If they think that they don't need to, they let the markets function. In fact, in certain segments of the market, the French central bank is so large, there is no market. If the free market is truly working, why do we hang on the word of 5 central bankers? It's not a market. It's a central bank market, right? And so therefore, the market refuses to believe that the central bank won't bail them out. And that's the moral hazard of central banking itself, right? And by enabling that interest rates to come lower through increasing central bank puts, essentially we've created large asset bubbles. Now, as we know, there's concentration also in land. Land is 250% of GDP, and a 30% drop in the GDP. Your Basel 2-3% increases in capital is not adequate to deal with a collapsing asset bubble, either in the second market. Now, Andy Haldane, whom I highly respect, says we need a systems of systems view of complexity, and I totally agree with him. In complex systems, the whole behaves very differently from sum of parts. We're dealing with scale-free, super spreader network effects. But the hierarchical winner-take-all, winner-have-all inequality is an inherent part of the global world. And central bank now becomes a reinforcer of that inequality, which there's been a separate session. But the problem is that complexity adds to fragility and increases inequality. So what concentrations are we talking about? Well, if you really think through this, the world in the last 30 years have become concentrated in any field you can think of. There are only 4 accountants left, basically. There are only 3 rating agencies left, right? The central counterparty platforms, maybe there will only be 3 or 4. And as I said, central banks are also part of this, because they are the bulk of the trade payment clearing are in the central banks. But the problem was that the central bank is an agent of the principal. The principal is the public. And increasingly, exactly like derivatives, the derivatives have a life of their own, and now central bank is entered into a trap. They don't know how to reduce their balance sheet. They don't know how to get out of this without huge consequences. And like the rest of banking, technology is changing the game. Because unless they are defended through laws that defend central bank as final money, Bitcoin and other technologies, is shifting into dark pools in which central banks cannot control. And so, central banks, think that they can actually manage global payments, global liquidity through final money. Technology is changing the game. Now, why do I say this? I wanted to think about this in a sort of a counterfactual way of thinking about it. What is a crisis? A crisis says a system just goes on increasing bigger and bigger until it stops. And then it implodes and it cleans out all the bad effects and you start all over again. But central banks have prevented that. Right? Central bank intervention has displaced the financial intermediation of the role of the market. Not all of it, but quite a lot of it. Bailout and subsidize basically it's smaller and smaller number of counterparties. Central bank counterparties are now relatively small because they're dealing with too big to fail banks, too big to fail asset managers, too big to fail counterparties, etc. And that's only a very small amount. So the beginning to take the humanity out of the agent has taken the humanity out of the principal, which is the masses, right? And that's where the inequality comes on. So this is the central bank trap. As we all know, on the fiscal side, no taxation without representation. Central bank promises, you're not going to have inflation or you're not going to have deflation, but are they democratically elected? They're not. Central bank action is essentially quasi-fiscal taxation. Okay? And quasi-fiscal taxation, because any interest rate below the real rate, de facto has its regressive effect on the masses who are doing the saving. And so central banks have become engines of inequality without intending this to be in the policy, because that's outside their normal realm of comfort. But the part is cannot escape the fact that it's part of the whole. And so we're seeing this very complex feedback effects, between the central banks who try to operate on a national basis, but their dysexternalities are affecting the rest of the world. And that externalities do not affect the big and the rich, but it affects the emerging markets who don't have that tool to deal with this. So if central banks have become even more concentrated, they easily fall into intellectual capture, and whatever they do, like all the regulations on prudential or monetary policy, subject to huge lobbying effects, as we all know. So to paraphrase the great leader Lee Kuan Yew, who unfortunately passed away recently, central banks need to do what is correct, not what is politically correct. And unfortunately, the problem is that the way the world consumption operates is that there's no hard budget constraint. I used to think, working on the Soviet economy when I was at the World Bank, that the Soviet economy had no hard budget constraint. Today, I realize, even democratic capitalist economies, there also is no hard budget constraint because you can print amount, the amount of money to finance the unsustainable consumption. And because fiscal action is already trapped by unwillingness to take unpopular, tough action or structural reforms, can costless QE, just expanding the balance sheet, is a soft option. It's actually reinforcing the lack of a hard budget constraint. It's a soft budget constraint, right? With no constraints, in fact. And so I think, in reality, central banks are supposed to take away the punch bowl. If they can't remove the punch bowl, maybe they should speak power to the truth, and maybe they should remove themselves if they think that they cannot do, in order to tell the public that central banks are not the solution. Today, if they're not careful, they are part of the problem. Thank you very much indeed.
Thank you, Andrew. Now we move to Lord Adair Turner.
Thank you, Rob. Press on. I'm going to make the argument that there does indeed need to be a new politics of central banking, because the model of the relationship between central banks and governments and their accountability and their objectives and tools, which existed before the crisis, were inadequate and failed. But I think we're still a long way from defining what that new politics of central banking is. And I would say that in the central banker community, the predominant belief is that after a period of turbulence, we will manage to get back to the pre-crisis certainty and the clarity of the pre-crisis system. But I'm going to argue that there is no going back, and that there is more work to be done in defining what the political arrangements of central banking should be in an environment where central banks have a far more complex job than existed before the crisis. I'm going to focus entirely on the classic central banking case, where you have one central bank which bears a relationship with one nation state. I'm therefore not going to comment on the very sui generis problems of the Eurozone, where the specific political economy construct is that we have one central bank which relates with many nation states, which in Charles Goodhart's good term are sub-sovereigns, i.e. they are nation-state debt issuers who are not currency issuing powers. That has a very specific set of implications that we might want to touch on in questions, but I'm not going to deal with those. So what was the old politics, the old accountability, the pre-crisis certainty of central banking? Central banking, which, as Perry has said, had its origins, and as Andrew has mentioned, had its origins in many activities which were not to do with controlling the rate of inflation. I mean, the Bank of England initially was a debt management war finance agency for the government of Britain. The Federal Reserve initially was focused on the supply of an elastic currency, essentially to make sure that the money supply moved flexibly with the working capital demands of a still predominantly agricultural economy. But despite that past of a quite heterogeneous set of roles of central banks, over the 30 years before the crisis, central banking gravitated towards a particular definition of its functions, its tools, and its accountabilities. The function was to achieve, it was supposed, low and stable inflation, which was increasingly defined as being about 2%, plus or minus 1% or so, and to do that by moving one instrument, which was the policy instrument, which then affected market interest rates. So it was a nice, clear, one objective, one policy instrument system. There were certain rules that underpinned that, and absolutely crucial to it was a total prohibition of monetary finance, a statement that the one thing central banks should never do is step over into the fiscal domain and be willing to finance fiscal deficits. And those roles, therefore, implied that central banks really were not involved in the process of thinking about the total amount of credit in the economy, and certainly not about the allocation of credit between alternative different ends, as long as the total amount of credit being created was compatible with low and stable inflation. And this was a package of beliefs which actually, therefore, enabled a very simple political construct. Because if you basically say the role of the central bank is to hit low and stable inflation using one policy instrument, you can have a very clear both independence and accountability. Independence to move the interest rate to hit that target, accountability, did you or did you not hit that target? This was a very appealing, intellectually elegant system, which left central bankers with a great deal of prestige for the mysterious ways in which they made their decisions and operated. They appeared to be successful. They appeared to be achieving a great moderation. And bluntly, the central bankers of the world enjoyed both the independence and the accountability that came from that. It was a clear system. It was a rule-driven system. It was an intellectually elegant system. And it was a system which completely and utterly failed in the crisis of 2007 and 2008. We thought that we had central bankers who could, as it were, walk on water, but it turns that they sank rather badly in 2007, which of course made me think of Leonard Cohen. Now, you should never try and compete. You should never try and compete with Rob about anything to do with the lyrics of any genre of music. Rob has an extraordinary ability to illustrate that, though you may not have realized it, all issues of modern monetary theory have somehow or other been commented on by either Bob Dylan or Paul McCartney or Leonard Cohen. Now, most of us do not have encyclopedic knowledge of the lyrics of Leonard Cohen, but I would be willing to bet that insofar as you do know the lyrics of Leonard Cohen, you probably know the lyrics of Suzanne, which was one of his great hits. And I suddenly realized as he was talking that when Cohen says Jesus was a sailor when he walked upon the water, that what Jesus really wanted to be was a central banker. I have, however, realized that the rest of the lyrics must also, of course, relate in some way to our issue. So it's clear that when Cohen says, "For you've touched her perfect body with your mind," that must have something to do with modern monetary theory, but what precisely is escaping me at the moment. However, let me turn to my proposition. Why did this simple, elegant, clear, rule-driven structure of the pre-crisis years fail? Well, it failed essentially because central bankers paid very little attention and a decreasing amount of attention to monetary aggregates and credit aggregates. And in particular, they paid no attention to the fact that while they were achieving the great moderation of low and stable inflation, something was extraordinary was happening in terms of credit aggregates, with private domestic credit as a percent of GDP in the advanced economies growing from 50% in 1950 to 170% in 2007, and with that increase accelerating precisely in the 15 to 20 years in which we thought we were achieving the great moderation of low and stable inflation. But it was quite overtly the argument of modern monetary theory and of central bank practice that we could safely ignore that quite dramatic change in monetary aggregates. Because as Olivier Blanchard put it, we assumed that we could ignore much of the details of the financial system. Or as Mervyn King put it, the dominant new Keynesian model of monetary economics lacks an account of financial intermediation, so that money, credit, and banks play no meaningful role. And has been, as mentioned already by both Perry and Andrew, dynamic stochastic general equilibrium models, broadly speaking, have no banking system in them. or if you read the canonical statement of new Keynesian monetary theory, which is Michael Woodford's Interest and Prices, it is about 700 pages with hardly a financial system or a banking system or a credit dynamic in it. Now, how did they end up believing that we could ignore the details of the financial system and we just needed to hit low and stable inflation? Although the argument was not always explicit, essentially they were going back, I think, to a Wicksellian assumption. Wicksell argued that if you assumed that credit was extended to entrepreneurs or businesses to fund capital investment, then a crucial relationship in the economy would be between the market rate of interest and the return on capital. He defined the return on capital, the marginal productivity of capital employed by entrepreneurs and businesses in capital investment, as being what he called the natural rate of interest. And he then argued that if central bankers set the policy or the market rate through the policy rate, so that it was below the natural rate, you would get an incentive for overinvestment and malinvestment, and you would produce inflation. Whereas if the policy market rate was equal to the natural rate, which is equal to the marginal productivity of capital, you would get exactly the optimal amount of investment in the economy, and you would get price stability. He further argued that, of course, the problem is we cannot directly observe the natural rate, it's unobservable, but we can, once we've got the logic of the previous page, we can take it round the other way, and we say if we vary the policy rate to ensure price stability, then we know that the policy rate must equal the natural rate, because otherwise we wouldn't be achieving price stability, and therefore by hitting an inflation targeting objective, we know that the level of credit creation and leverage in the economy is optimal. So the assumption is that if we achieve low and stable inflation, we can ignore what is happening in the financial system, because the fact that we've achieved low and stable inflation will ensure that there is optimality in the creation of credit. The fundamental problem with that assumption is that it might be true. I don't think it would be entirely true for reasons that Hayek and Schumpeter explored, but it might be true to enough extent that we could work on that basis if all credit, or the vast majority of credit in the economy, funded new capital investment. But the fundamental fact of modern credit systems is that the vast majority of modern credit does not fund new capital investment. It funds either consumption or it funds real estate purchase, which is in particular a competition between people for the ownership of irreproducible capital, that third element of capital, which Joe Stiglitz talked about in his talks on Wednesday evening, which we need to bring into our economic models alongside the capital which is built specifically out of the flow of savings. And once you realize that the vast majority of credit in modern economies supports the purchase of the irreproducible capital of existing real estate and the limited supply land on which it sits, then you realize that we are highly likely to have these very strong credit and asset price cycles where more credit extended drives up increased asset prices, which through both the expectations and behaviors of borrowers and lenders drives yet more credit extension. And the problem is that we get these strong credit and asset price cycles, and then we get a Minsky moment, and we get the reverse of these cycles, and we have post-crisis debt overhang and deflation problems. All of which means that monetary aggregates and credit aggregates, the size of balance sheets, the amount of leverage in the economy matters a lot, but it matters for a completely different reason than the monetarists of the 1960s and 70s believed. Essentially, monetary aggregates matter not because excessive money creation is a good forward indicator of inflation. It isn't because a lot of money and a lot of credit is not increasing direct nominal demand, it is increasing asset prices alone. Monetary aggregates matter because excessive credit creation can be a forward indicator of crisis, debt overhang, post-crisis deflation, depression and deflation. All of which means that the idea that we can have one objective and one instrument is totally inadequate. We cannot simply have the objective of low and stable inflation, because credit and asset price cycles and rising leverage can produce macroeconomic instability which will never show up in a higher rate of inflation to which an inflation targeting central bank will feel the need to respond. And we cannot rely simply on the interest rate tool to contain the credit and asset price cycle, essentially because the interest rate elasticity of demand for credit varies by sector. If you have a credit and asset price boom in real estate, and people have internalized the expectation that real estate prices are going to continue to go up at 10 or 15% per annum, then raising the policy interest rate by 0.5% will be very ineffective in slowing down that credit and asset price boom, and raising it by 5 or 10% will do serious harm to the rest of the economy. Essentially, we do not have one natural rate in the economy. We have a heterogeneity of different expectations of rates by different borrowers in the economy, a thought which I believe is somewhere in the general theory. All of which implies that we will have to have other policy objectives and tools. Central banks or macroprudential regulators or someone will have to constrain both the pace of growth and the level of private sector leverage, and they will have to offset the bias in the system, which is a very strong bias towards real estate lending. That implies that there are a set of tools which are important not merely for the stability of the financial system, narrowly defined as the low probability of the failure of commercial banks, but important for the overall macroeconomic stability of the system, a set of tools such as much higher bank capital requirements, much higher counter-cyclical capital requirements, the ability to increase capital risk rates for real estate lending above those that private assessments of risk would suggest are appropriate, the use of loan-to-income or loan-to-value constraints on borrowers, and perhaps also the creation of banks with dedicated focus on what our economic textbooks say banks do, which is lend money to businesses to fund capital investment. All of which says that somewhere within the policy process, we have to locate an overt management of the total quantity of credit which the system is creating, and, to a degree, the allocation of that credit between broad categories, without getting into a micro-allocation of credit, but at least having a point of view of the balance between the amount of credit flowing into new investment and the amount of credit going into various forms of speculation. All of which means, however, that some of the things that central banks have been doing over the last 5 years are not going to go away. They're not simply things that they did in the crisis which will disappear. They are probably going to be part of the toolkit for the future. What is interesting, if you look at this page, is a lot of central banks have been doing things which are completely against the pre-crisis orthodoxy. The pre-crisis orthodoxy was the one thing that central banks certainly should not do, is take a point of view as to whether credit was more valuable in one sector of the economy than another sector of the economy. But the Bank of England now has a funding for lending scheme with, it says, a set of incentives skewed to make sure that that supports SMEs and not residential mortgages. That is also true of the ECB's targeted LTRO program. It says, I'm not going to support mortgage lending, but I am going to support non-mortgage lending. It's also true of actions by the PBOC and the Bank of Korea. I think these are part of a new toolkit of management of credit, which we have to locate somewhere. What I'm not sure is exactly how we locate that, because quite clearly, once you have those responsibilities, this goes beyond something that you can clearly and simply account for by saying, hit an inflation target, and I'll measure afterwards whether you've successfully done it or not. It is giving a high degree of discretion to central banks, but with discretion has to come a different form of accountability as to how that discretion has been used. Let me, however, move on to one other issue much more briefly, which is the issue of how central banks or somebody else or a combination of central banks and macro regulators or the Treasury should have a point of view of the growth of credit, and its allocation relates to what went wrong before the crisis, the things that we should have done to stop us getting into the problems of 2007 and 2008. But we are where we are, and we end up with a very large debt overhang. And there are then many major issues about what central banks do in a debt overhang situation, because once we have created too much debt in the world, we are faced with some very fundamental problems. We ought to have seen those problems coming because they had been well illustrated by the Japanese experience in the 1990s. The 1980s in Japan was probably the strongest version we have ever seen of that green cycle I showed earlier of credit and asset prices. It reaches a Minsky moment in 1990. There is a collapse of confidence, there is a collapse of real estate prices, and the corporates who have invested huge amounts of money on credit in real estate suddenly get worried about their balance sheets and they get determined to pay down debt. They are so determined to pay down debt that they are almost inelastic to the reduction of the interest rate to zero, and therefore the only way that we can offset the deleveraging of the corporate sector, which is shown on the red slide, is to accept a relentless upleveraging of the public sector, which is shown on the blue slide. We seem to enter, post a crisis, an environment where once we have too much debt, we don't know how to get rid of it, we simply know how to shift it around in the economy from the private sector to the public sector. And it is that pattern which we saw in Japan in the last 25 years, which has been repeated in all the developed economies since the crisis of 2007. Before the crisis, we saw a significant increase of the leverage of both non-financial corporates and households, with actually some reduction of public sector debt. Since the crisis, we have seen the beginnings of deleveraging in household sectors, particularly in the US, less so elsewhere, and at least a stabilization in non-financial corporates. But for every percentage point reduction in the debt of the private sector, there has been a more than percentage point increase in the debt of the public sector. And the problem is that that seems to leave us in an environment where all our policy levers are blocked. We use fiscal expansion to offset the deleveraging of the private sector, but after a while we worried about debt sustainability, so we apply austerity, and then we have both the public and the private sector attempting to deleverage. So we try to have fiscal austerity combined with ultra-loose monetary policy, but as Andrew has mentioned, ultra-loose monetary policy, both by zero interest rates and by attempts to drive down long-term interest rates, although I think they are better than nothing, they have serious collateral side effects. They tend to increase inequality, and ultimately, ironically, they can only work by re-stimulating the very growth of private credit, which got us into the mess in the first place. So if we don't have a set of policies in advance to manage the credit cycle, we seem to end up with an unavoidable choice in terms of debt, that we will either have to accept debt write-offs, defaults and restructuring, or we will have to erode debt through inflation or monetization, or we will have to stimulate yet more credit, which simply piles up problems for the future, or we will be stuck in a sustained slow growth and low deflation trap. What do we do in that environment? Well, I think we have to be clear that the one problem that cannot exist in a modern economy is an absolute inability to create nominal demand. Nominal demand is the one thing that a fiscal and a monetary authority come together could, if it wants, always create. And it can always create it by essentially doing what Ben Bernanke, there's a person who doesn't want me to mention helicopter money. There we are. By what Ben Bernanke suggested to the Japanese in 2003, which is overt money finance, helicopter money. If we are short of nominal demand, it is always possible to run fiscal deficits which are monetary financed. And I personally believe that we should have thought about that over the last 5 years. That if you compare, for instance, in the UK, the option that we did pursue, which is 350 billion of QE with a commitment apparently to future reversal, plus funding for lending, plus relaxation at times of bank capital and liquidity standards in order to use the transmission mechanisms of low interest rates, working through the classic QE levers, compared with a smaller amount of overt money finance and increased fiscal deficit explicitly and permanently financed by the central bank, I think we need to live in an environment where we debate whether the option 2 would have been better than option 1. But that, to end with, of course, completely breaks one of the central tenets of pre-crisis central banking, which is that monetary finance should be completely and utterly prohibited. And indeed, there is a crucial political economy issue on monetary finance, which is how do we limit monetary finance with appropriate rules? I think it is clear that small amounts of monetary finance, permanent monetary finance, could at times be favourable tools of macroeconomic management. But it is clear that monetary finance pursued on a very large scale does indeed take us to Weimar. What we have lived with in the past is a political economy construct that says we simply cannot trust ourselves with monetary finance, that once we accept that monetary finance is possible, we believe we will inevitably go to use it to extreme. So as part of the political economy of central banking, we also have to think about whether we need a set of constructs which locate the option of monetary finance with the same rules that we had in the past. Could it be possible, for instance, to locate with a central bank, in pursuit of an inflation target, a responsibility to say, yes, we can have this year a certain amount of monetary finance, but only this amount, not more. So I end, therefore, with the thought that both in terms of what we have to do to better control the upswing of the cycle and the way that credit can run out of control in a way that will never show up in inflation, to which an inflation targeting central bank responds, and in relation to the tools that are required to get out of the debt overhang, we are in a very, very different position. We will have to ask central banks to do a far wider set of things than they have done in the past, but once you accept that, you can't simply reduce what they do to a very simple set of rules and say, you hit an inflation target and that's it, without some degree of coordination with other aspects of policy. That defines the problem rather than the solution, but I think the problem is a very deep one and that we're not going back to the pre-crisis orthodoxy.
Thank you, Dare. So recently, the hedge fund manager Ray Dalio, who manages Bridgewater, put out a memo that from his firm comparing the situation in the United States and the world right now to 1937. And he talked about, in 1937, of course, was when the raising of rates and fiscal cuts were implemented and America started to plummet towards a second leg of the Depression before World War II ensued. Dalio, and I'm asking all three of the panelists, Dalio is warning the central banks not to give up on quantitative easing and not to begin tightening, because he believes that asset markets, both equity and bond markets, are at such a high valuation now, and that monetary policy cannot push on a string, and so that we're in a very treacherous circumstance. Now, Dare, you were just speaking about this, but I'm curious how each of the three of you see the challenge that central banks face, like the Federal Reserve at the, how do you say, near the exit ramp of a quantitative easing prolonged strategy. What did you say?
So you're asking me about the slides that I skipped. The exit strategy. This way of thinking about the world that I was sort of sketching here, you ask yourself, well, what would exit look like? You know, where are you headed? What are you trying to achieve? And I think it's important to appreciate that exit is not about returning to status quo ante, okay? That it's about imagining a possible future. The key thing I would emphasize, if we're going to be living in a world of market-based credit, is that the price of funding and the price of the assets has to no longer be a policy, something that the Fed or other central banks are setting as a matter of daily policy, which they are basically now. That means, as I said on the slide I skipped, that the Fed needs to stop making the inside spread, okay, being a dealer of first resort, and make the outside spread so that it is supporting the market instead of being the market. And that means moving on both sides of it. You know, having your money market funding rate, that is to say, the deposit rate at the Fed, lower than the money market rate in private sector, and that this is the challenge. And it's going to be a very volatile thing. This is what Dahlia was afraid of, okay? That if the Fed stops supporting markets, people have stopped making markets. If the Fed isn't making markets, then the Fed is making markets, why should I? You know, this is not a profitable thing. The Fed doesn't have to make money, so why should I compete against the Fed? I do need to make money. And that is the transition to markets is the challenge ahead of us, is moving from a system where the central banks are making markets to where, private profit motive, and where dealers are thinking about what is profitable and not thinking about gaming the Fed. Okay, that's the game right now, is what are central bankers going to do, and let me game them, okay, not thinking about the future.
Andrew?
I think I want to take Perry's point about the market not working and central bank is, substituted for the market, right? Now, why isn't the market working? Well, it's, as Sir John Case said, it's all about short-termism. And central bank operates on the short term and is worried about the long term. But the long-term problems are staring us in the face. The world is going through major climate change, and at near zero interest rates, there is no money for climate finance. Okay? So I take a very simple view of this, right? I take a very simple view of this. If the central bank is in charge of liquidity in a system, the central bank is a gardener. Okay? Now and the whole garden, it's not becoming more diverse. It's actually becoming more concentrated and more homogeneous and therefore more fragile. And so you say, with a short of liquidity, let me spray the liquidity. But unfortunately, only one corner of that garden gets all the water, and the rest of the garden is dying, which is exactly what we're facing, right? It's not that the world is short of money. The money, we need climate finance to deal with this. So if central bank is going to give money to just its counterparties and just buy the bonds from the asset managers, why can't it says, I want now to lend at zero interest rates, 25 years for climate change projects? That will send the right signals, because the gardener basically is saying, I can't steer off. I can't lean against the wind because the wind is too strong. But my job is to play Tai Chi. I steer the system in the area which I think is going to be in the right direction. And therefore, why can't, if the central banks are willing to spend money on long-term government bonds, which basically finance government fiscal deficits, why can't the central bank lend in this area? So the chart that Adair did this is showing that the central banks are beginning to lend towards SMEs, right?
Yeah.
So, and basically the central banks are beginning to suddenly talk about financial inclusion. Why the hell do we need to talk about financial inclusion? Because there is exclusion. And they're doing very little about it, because there's inequalities outside my purview. But actually, the biggest problem, what is the art of politics? It's pick important problems, fix them, and then tell everybody. And what's the biggest problem today? Climate change. If we carry on doing what we're doing, we're going to all burn out. So we need to do something about it. And so therefore, if central banks have the ability to create that balance sheet and induce this funding in that area, give you a simple illustration. People's Bank of China, when they try to return that liquidity back to the market, What did it do? It actually lent $1 trillion to the China Development Bank to finance low-cost housing. And what did that signal tell people? It did two things. It told the guy who cannot get a house, right, all the migrant laborers that they can't get a house in the newer urban area, that the central bank is behind me, point number one. And point number two, it actually builds infrastructure and the aim for the long term, which you can't do. So in my view, if emerging markets are now beginning to experiment in this area, maybe advanced central banks, may be thinking about, using different tools that address the issues of our times instead of basically feeding just that part of what I call the garden that is thriving while the rest of the garden is short of liquidity. Thank you.
I think what Ray Dalio's comments illustrate is the trap that one is in if we first allow too much debt to be created. Because it appears to be the case that if you accept, and of course some people would not accept, that there are constraints on the increase in public debt, that there are constraints on the extent to which you can offset the private deleveraging with public up-leveraging, then you appear to have to rely on ultra-loose monetary policy, but it is an imperfect mechanism. And I think what Dalio's comments illustrate is the problem that you're in if you have excluded some more radical policy options. If we basically work on the basis that we have to control the fiscal side, that we cannot have a limitless fiscal stimulus, and we offset that by ultra-loose monetary policy, you then have to ask, well, what is the transmission mechanism of ultra-loose monetary policy? And by ultra-loose monetary policy includes policy rates at zero or negative, forward guidance to tell people that they're staying there for some time, and QE to bring down the long end of the yield curve as well as the short end of the yield curve. How does that work? Well, for one country alone, it can work through the currency lever. But for the whole world together, it cannot work through the currency lever. And we're seeing an interesting example of that at the moment, that European QE is affecting the currency lever and somewhat stimulating the European economy, but it is having a precisely offsetting effect on the US economy by the rise in the value of the dollar. If we have a global problem of too much debt and a post-crisis debt deflation problem, then by definition, the currency lever cannot be a solution to a global problem. So what are the other transmission mechanisms of ultra-loose monetary policy? Well, they're working through the interest rate itself, setting a very low interest rate, which it is supposed then encourages somebody to go out and borrow money. But I think there are two problems there. First of all, it may well be that the elasticity of response is far higher in relation to various forms of fancy carry trade and financial speculation than it is in relation to real economy lending, where reducing the interest rate from 0.5% to 0% is unlikely to produce a transformation of real economy business behavior. So that's one problem. And the other problem is, if it does work, it takes us back into the regrowth of private credit, to the increase in private credit, which got us into the mess in the first place. And there's a very interesting chart in the UK government's Office of Budget Responsibility, where they say the UK economy will grow over the next 5 years, and we will get public debt under control, but it also suggests that private debt, having somewhat deleveraged, will over the next 5 years completely return to the level of leverage which was at the maximum in 2007. So does it work through the interest rate? An imperfect lever. Does it work through asset prices? And the idea there is a sort of Tobin's Q type idea. The market price of assets goes up. People have more incentives to invest. Portfolio reallocation effects. Price of bonds go up. They buy equities, etc. These are imperfect transmission mechanisms to the real economy. Eventually, they probably do work in some way, but they work with collateral damage in terms of increased inequality. They work with collateral damage in terms of financial fragility. The crucial issue is, are there more direct transmission mechanisms to affect demand? Should we be using small amounts of direct monetary finance, or small amounts of direct development bank finance. For instance, within the European Central Bank's QE program, when I think about the transmission mechanism of that QE program, the one bit where I can see a certain transmission mechanism is the 12% of the QE which is allocated to buying newly issued EIB bonds, which then turn into new forms of investment. But the central problem I think we have with QE is that I think it's better than nothing, and therefore I think it will only be removed at a very slow pace. But by excluding from the public policy place the more direct and certain mechanisms of transmission through to nominal demand, we have ended up relying on a very imperfect set of instruments with a large amount of collateral damage.
Thank you. We have a little bit of time for questions. What I'd like to do is field about 3 questions and then let the panel respond. Right over here, is that Steve?
Hi, Steve King from Kingston University. If you admit, as you have today, that private debt is the problem and shuffling it from the private balance sheet to the public is not going to work, what are your reflections on the proposal that I've called and a few others have called quantitative easing for the people? We'll use that money creation capacity of the government to monetary back a deficit, finance the private sector, but partly on the condition that those who receive that money who are in debt have to pay the debt down.
Adair, in your brilliant presentation, you mentioned that one way of dealing with a debt overhang was debt restructuring. And then in your final slide, you said that basically there are only 2 options. But what role, if any, do you think there is for debt restructuring, which is not, of course, incompatible with your proposal for overt monetary finance?
Failed on a narrow mandate of microprudential supervision, what actually leads you to believe that central bankers might do a better job at the wider macroprudential supervision? And should we not envision some other form of global governance of the economy?
My question is, people use the term debt overhang as if it means something when actually the debt has been transferred to the safety net. And the real issue is the writing down of the private claims. We've got a lot of insolvent banks whose incentives are greatly distorted by their insolvency. They are looking for big hits, something that will float them back. And in the United States, people have been comparing this to the 30s, but I think you can compare it to 1989 when the S&Ls, the whole industry was virtually insolvent, and their role in financing unneeded buildings was wasting resources. And what once it was decided that instead of keeping them in play, just let's create a resolution trust corporation, let's write down the assets and manage the losses in the real investments and get on with it. Then we had a great recovery in banking and in the GDP. Thanks.
If you want to get rid of private debt or not have it, the problem was securitization of private debt, which the feds allowed. If you didn't allow securitization, the bankers would have been stuck with skin in the game on these mortgages, and they wouldn't have done what they had. So I think that you've got to get rid of securitization of private debt. Second one, and something nobody's ever spoken about, but globalization. What happened to the Keynes plan? If you want to have globalization, you have to have a system which Keynes said basically the nice thing about the Keynes plan was that the world reserve, which Perry mentioned, cannot be speculated by private enterprise. So you can't get the dollar-euro problem and get people to make their industry competitive by devaluations. It seems to me those two things have to be addressed and are always overlooked for some strange reason.
I wanted to go back to a topic that was briefly mentioned at the beginning of Andrew Shank's talk, when he said that central banks were thrown into this by fiscal policy lack of action. The background of this is, of course, that the mainstream economics sent fiscal policy management to the archives of economic history some time ago, along with the discretionary approach. And this is how central banks got the full burden of macro stability and financial stability. What we now find is that central banks have no control of the monetary aggregates that matter. We find that all they can do is swap assets, and the more assets they swap, the larger their balance sheet gets. And we may find that they may not even be able to control inflation. And if they are not, it's not really a big issue whether they do not control inflation democratically or they do not control inflation undemocratically. But this suggests to me that there is also in terms of new economic thinking, a need for reclaiming the fiscal tool and find new ways or new guises for the fiscal tool. The two last options in the last slide of Adair Turner, I think both can work. One works with increasing private debt, and the other works with increasing public debt. Perhaps we should ask also the question of what is the sustainable relation between private debt and public debt.
We have a mosaic of questions, and I'll let each of you take hold of different parts. Barry, would you like to start?
Well, most of them were for Adair, so I'll just be focused here. The issue of private versus public credit, the issue of debt write-downs, I think it's maybe take off from the point that Adair was finishing on about the European Investment Bank. I mentioned in my answer to the previous question about the necessity to get private credit going again, and then that means the Fed serves as outside spread instead of inside spread. But that is not inconsistent with also saying we could get public credit going again by various forms of public intermediation for infrastructure development and so forth. It's not necessarily, I mean, Adair wants this all to be financed by the central bank, but it doesn't necessarily have to be so, as long as the central bank is acting as backstop for the credit, that it's willing to accept this credit as collateral. That is probably sufficient, as a matter of fact, to make it go. So I'm in fact, I think it would be a good idea if the United States joined China's initiative to have a broad infrastructure bank that has world projects in mind, and to do this also in the United States, as a matter of fact, as well. I think that's also maybe a bit of an answer to Steve Keen too, although he didn't address it to me, about using the central bank not so much for direct finance as for backstopping the bond issues of state agencies that are created for public investment purposes.
Yep, thank you. I want to say, when we're in the 21st century, we need to tackle 21st century problems with 21st century tools. We can't use 19th century stuff. The issue here is really this. Is debt a symptom or a cause? We see the symptom that the debt is rising very, very rapidly. But if you think about it, now debt is a silo thinking. I'm shifting my risks to you because if I lend to you, you bear all the risks if you can't pay. Equity is risk sharing. For a system as a whole, if I, invest in you, and if you lose, of course there are governance issues in this, I should bear the responsibility of them. This is how I see the Greek problem. The European Union, I'm sorry I'm talking through my hat because I know very little about Europe. But the European Union, and I thank this Martin Wolf, who may be here, for clarifying this for me. The European Union is not a banking union, is not a fiscal union, is not even a monetary union, it's a union of central banks. Essentially, at the clearing level, one party cannot pay. who shares the loss? And that's the heart of the issue. So if the central banks share the loss, then it's a risk share problem. And in reality, that is the reality, that if one party loses, the other central banks share the losses. But you say, no, this is debt, you can't do this, and you have to adjust fiscally to do this, and therefore the system then gets into a situation which you can't control. So in my view, I think the problem today is that we've gone overboard on debt versus equity. And a large part of this reason is the tax on debt is favorable and the tax on equity is not favorable. And so we've ended up with a very large shift that has financed the inequity in the system because the rich don't want to pay tax. And that's totally understandable. So I think that's the heart of the issue that we need to think about. That yes, debt is a problem, but debt comes from the consumption. So where's the asset, and how should central banks deal with this ultimately? Thank you.
Can I just begin with a general comment for a clarification of what I think is an important issue? I think we have ways of creating nominal demand which create both immediate nominal demand and some future debt that has to be repaid, which may or may not have a consequence. And that is true both in terms of private credit, where we fundamentally create immediate money available, but we create a debt that has to be repaid, which creates leverage and consequences. We can do it through public credit, where we have an immediate fiscal stimulus, but there is a fiscal debt which has to be repaid in the future, which may or may not, depending on your point of view, produce Ricardian equivalence offsets effects, but certainly is something you have to think about. And then third, we have categoric sovereign fiat money, right, which has no matching debt against it. That's what's different about overt money finance, about categoric fiat money. Let me, with that as context, comment first of all on Steve's point. Once you realize that that is possible, that it is incredibly dangerous in large quantities, but useful in small quantities, the question is then, how do we use it? And there are a variety of ways you can use it. You can basically say, I want to avoid any distributional issues, so in some sense I do the same amount to everybody or the same percentage amount, and that, for instance, is the proposal roughly which Francesco Giavazzi and Guido Tabellini have put forward last year for the European Union. Or you do it, you give essentially monetary finance to the EIB and it ends up in investment, or you take it and say, I specifically want to give it to particular groups of people to pay down their debt. I think all of those are different choices. Obviously, the more you get away from across the board type approaches, the more that you've got to make a set of distributional decisions which will be argued about, because for somebody this feels like to them some element of a free lunch. But I certainly don't exclude that we could use it in order to pay down specific quantities of debt and get debt out of the system. But you can see why some people, having realize that the tool is available, want to use it in a very neutral way in order to just get the nominal demand out there without worrying about distributional decisions. That then relates to Philip's point about debt restructuring. I absolutely do not exclude the box which said debt restructuring. Indeed, I think Atif Mian and Amir Sufi in their book have put forward a very good argument that the US response to the crisis should have involved a more significant element of private debt restructuring in the mortgage space to get excessive debts out the way. I think there's a good argument that, for instance, in Ireland and Spain, that would also have been a very useful part of the process. Of course, it does end up with, again, you have a distributional issue, because once you're into private debt restructuring, you've got to make a decision on who's getting the debt write-off. And you can see why that ends up as a politically difficult decision to do. It gets easy when you can say to the private bankers, well, they're not going to pay back in any case, so you might as well write it off because you're not getting it back. But when it becomes a socially organized thing, it's more difficult. It actually becomes easier once you've socialized it by the debt moving to the public side, which is why, to go back to the debates yesterday, do I think that there will eventually be either a Grexit or a Greek debt restructuring, I think it's inevitable there's going to be one or others. I see no way that Greece is going to repay the full nominal value of the debt that it has on its balance sheet. And I think public debt restructurings are, in a sense, easier than private debt restructurings because you've got it all in one place and you can make decisions there. But there may have to be public debt restructurings as well as public monetizations. And I think that relates to the issue about the debt overhang and the writing down that somebody mentioned as well. And then finally, Antonio's point, I've described a world in which I'm handing to these central banks or to somebody a whole set of complicated tools to vary the risk weights on commercial real estate lending or residential real estate lending, pull LTVs, LTIs. You know, given that they didn't do a great job in the end before the crisis, why do we give them all these more tools? And indeed, many of the central bankers themselves, as Rob said earlier, said, don't overburden us with too many tools. My answer is, we've got to accept reality. We live with a credit and money cycle, an inherent instability of the credit and money creation process that we will have to try and manage in some way. So we have to try and locate our control of that somewhere. We should do that as much as possible by defining constant rules in advance that do not have to be varied in a discretionary fashion, such as much higher capital requirements, much tighter liquidity requirements. But I think there will inevitably have to be a discretionary fashion. Now, I am a supporter of the structure that we've put in place in the UK now, which has located within the Bank of England, alongside a monetary policy committee, a financial policy committee that does have quite a wide set of levers available to it to slow down credit cycles, and where the accountability derives from the reports that it has to give to government and the people about how it is using those tools. But what I would say is I completely accept, we have a problem here, that we've got an unstable system that we've got to manage. Somebody has to be given discretionary power to manage it. We're always worried about where are these competent, wise people who will use that discretionary power. But I don't think we can solve that problem by saying, well, we're not going to have the tools, because it goes back to Perry's point. The credit and asset price cycle is defined by Hayek, by Schumpeter, by Minsky. This is an inherent instability at the core of a monetary economy. And any set of rules where we say we're not going to have any discretionary policy response to that is not going to work and is going to take us back to the crisis that we've suffered.
Well, I thank all the panelists, and there's only one remaining task, and that is that your moderator has to plot his lyrical exit strategy. Right. I return to the point that Adair brought up about Jesus walking on water. What Adair might not realize is that very same verse goes like this. And Jesus was a sailor when he walked upon the water. He spent a long time watching from his lonely wooden tower. So far, so good as a central banker. And when he knew for certain only drowning men could see him, he said, all men will be sailors, then until the sea shall free them. But he himself was broken long before the sky would open. Forsaken, almost human, he sank beneath your wisdom like a stone. Now, Leonard Cohen spoke also about democracy, and this is a panel on politics. And in his song, Democracy, he says, sail on, O mighty ship of state, to the shores of need, past the reefs of greed, through the squalls of hate. Your ship, the cradle of the best and the worst. It's here they got the range, the machinery for change. It's here they got the spiritual thirst. It's here the family's broken. It's here the lonely say that heart has got to open in a fundamental way. Then, in his song Anthem, he goes on to conclude that we asked for signs, the signs were sent. The birth betrayed, the marriage spent, the widowhood of every government. They're signs for all to see. I can run no more with that lawless crowd while the killers in high places say their prayers out loud. But they've summoned up a thunder cloud, and now they'll hear from me. We'll ring the bell that still can ring. Forget your perfect offering. There's a crack in everything. That's how the light gets in. Meeting adjourned. Thank you.